I'm going to show you what has happened recently and what may be coming up in the REIT space. Let's look at this chart over here. Year-to-date performance for all shares in Singapore. And as you can see, everything is red, correct? Especially for S-REITs. Only 4 of them in green. But if we change it to 1 week, boom, green like a garden. In fact, 17 of them have gained 5 to 15% in the last 1 week, which is a broad-based rally. Now let's see details of who has gained, and I filtered based on the 1 month performance. This is the list headed by Digital Core REIT, Prime US REIT and Keppel DC REIT. Speaking to here, I also advocate don't buy what has shot up the most because they are likely coming off from very low bottoms. At the top of this list, you'll see that Digital Core REIT, Prime US REIT, Keppel Pacific Oat US REIT and Manulife US REIT are all US based. Using Prime US REIT as an example, gross revenue is dropping, net property income is still dropping because occupancy is weak. If you see over here, it's still 30% below pandemic levels and kind of stuck there. The supply demand over there is very different from what you see here in Singapore. So as I've suggested many times on the channel, it's probably better to look at the largest REITs in Singapore. From this list, personally, I own Mapletree Industrial Trust, Mapletree Pan Asia Commercial Trust, Fraser Singapore Trust and Escort REIT. Then what I'd like to highlight next is Landlease Global Commercial REIT, which owns 313 Somerset as well as Suntec REIT. These two are also very high up in this 1 month performance chart because they've been beaten down very badly also. These two have very high leverage factors in their balance sheet. So why exactly have REITs suddenly flipped to the green? It is due to this reason, which is the US Consumer Price Index. In a latest report, for the June reading which just recently came out, the CPI reading reads only at 3% inflation. That was actually below market expectation and market is now celebrating. But what I'd like to highlight are these two areas in red, mid of 2023 and start of 2024. That was actually when the CPI index actually ticked up. And what we can see when we compare against, for example, Mapletree Industrial Trust, the uptick in CPI reading actually caused a correction in share price because market is expecting that Fed would hold interest rates higher for longer periods. Inflation reading is always very fickle, and the latest reading suggests that Chairman Jerome Powell hails considerable progress in tackling inflation. Further notes suggest that Fed wouldn't wait until inflation hits 2% before cutting interest rates. They are open to doing so earlier, and they have given indication that they will. So how has market responded? Up first is the US dollar index. What you can see over here is US dollar against a basket of major currencies, and in the last 1 month, it's fallen by almost 2%. This signals that investors are looking away from US dollars and selling it down. On the exchange, Sing dollar versus US dollar, you would realize that similarly, US dollar has weakened against Sing dollar. And that's why if you're buying US Treasury with 5+% in terms of yield, do note, exchange could cost easily 1 to 2% if it goes against you. More critical information next. The 10-year US Treasury note is suggesting that rates are also coming down. Latest yield is at 4.187% only, cracking the 4.2%. And take note again, REITs don't borrow loans overnight. They typically sell bonds that are 3 to 10 years. And that's why they actually track this more than Fed overnight rates. And with the US 10-year Treasury note cracking 4.2% yield, the big question is it going down for good? Now let's think about this. If consensus is that rates for next year will be 3 to 4% only for the long-term yield, what would happen? Analysts would naturally forecast that the REIT borrowing cost would drop, correct? And what happens next is that they'll be rushing to revise the DPU upwards. Why so? Because REITs have been dealing with a cost problem, not a revenue problem. If you look in terms of many REITs, for example, for Singapore malls, you can see Fraser Singapore Trust, who owns malls such as Next, North Point, and Causeway Point. If you live around them, you're probably very familiar with it. You would realize that the rent has been very strong, climbing consistently whether there's a recession risk or not. What about CICT? Retail mall performance is up. Office performance is also up. What about Mapletree Industrial Trust, who owns data centers? Gross revenue is up and net property income is up. And from this table, you can see the borrowing cost is up even more. So the problem has always not been the revenue, but the cost, which specifically drives to interest cost. So if interest cost is widely believed to drop for 2025 and beyond, what's going to cause a cut in DPU? Very unlikely, correct? In fact, the reverse is going to happen. A revision upwards for DPU projection as borrowing cost starts to slide down. So think about this now. Is buying the REITs right now high risk because the recent 1-2 year share price has been so terrible, or low risk because the biggest risk factor, which is interest cost, is subsiding? Let me know in the comment sections whether you agree or not. And this is a quick poll for my Telegram group. 2/3 are favorable about REITs right now. And if you're keen to learn more and join in the votes, look for my Telegram links below to join the official channel. For me as a REIT investor, it's heartening to see more positive news coming out like this, which is REIT index breaks out from a base formation as risk-free rates flounder. Specifically, FTSE REIT index seemed to have formed a bottom and shot up sharply in the last 1 week. There is no guarantee it will last, but my personal opinion is that I'm pretty hopeful of it. From a further Maybank research, CICT's target share price has been raised to $2.25. Ascendas REIT's target share price has been raised from $2.65 to $2.90. Not just Maybank, DBS Research has also mentioned favorable about S-REIT's robust run, with CapitaLand Ascendas REIT, Mapletree Pan Asia Commercial Trust, and Mapletree Logistics Trust as their top picks. I will be looking up and analysing a lot of the REITs that are reporting results very soon. On 24th July is Fraser Centerpoint Trust and Mapletree Logistics Trust. 25th July, Mapletree Industrial Trust and Suntec REIT. 26th, Escort Trust and Keppel DC REIT. And on 30th, Mapletree Pan Asia Commercial Trust as well as Ascendas. So if you're keen for more analysis, again, smash the subscribe button and journey with me as we reach 100,000 subscribers. So exactly what REIT to buy? Maybe I'll just use UOB Kay Hian's recommendation to start the ball rolling. Over here, they've made their Alpha Picks portfolio with Faiz Hospitality Trust, Landlease REIT and Mapletree Industrial Trust. I don't quite like the first two names in blue. Personally, I like Mapletree Industrial Trust, as I've shared many times on this channel. UOB Kay Hian has also mentioned about Mapletree Pan Asia Commercial Trust MPACT, which is anchored in Singapore and deleveraging for growth in Asia Pacific at a yield of 6.8% right now. They believe it's an attractive blue chip S-REIT. And MPACT has recently divested Mapletree Anson away at a very good price. With this monies coming in, they'll likely pay down the leverage, and this will improve DPU as well as improve its interest coverage ratio. This is a recent good news which made me change my mind, because previously I was more in line with this, that there's still risk of MPACT's overseas assets such as Festival Walk that's taken a long while to recover back to pre-pandemic days. I will be keeping tabs on it, and if you're keen to find out more, check out this video I have for you, which is 3 REITs to buy now.